Americans after office hours. It is Sunday, August 11th, and this is the market commentary for the week. Some commentators last week remarked that the stock market rebounded from Monday's sharp decline. There are a few caveats that need to be noted. The first is that the increase throughout the week occurred on unconvincing volume, which is, again, never something that would inspire confidence. Equally important, we had, relatively high VIX reading. As I mentioned before, this tends to be stubborn and certainly is not indicative of a market that is back on a firm footing by any means. We also have additional concerns based on the Treasury market, where the flight to safety trade is still on. There may have been a modest bounce during the week, but again, this is unconvincing. It's not in any way compelling evidence of a risk-on, market climate. We also have, unconvincing trading in the Magnificent Seven. The rebound here was so slight during the week that it is, somewhat difficult to see. There is a rebound, but again, it is modest. The most disconcerting evidence for a market recovery based on last week's action is here in the hot themes, the speculative segments of the equity capital market. You see them listed here. I track these. I've created comparable company sets for each of these investment themes. These are the parts of the market that had previously been the beneficiary of significant capital flows and a significant increase in valuation. This is where I would have expected a return to risk capital. If we were risk on, this is where I would expect to see it. This is the most troubling analysis. On the left half of your screen, you're seeing the results on a median basis, both in price change and relative strength to the market for those hot themes for the trailing 4 weeks, 12 weeks, 24 weeks, and 52 weeks. On the right side of the screen, the very same analysis as of the end of trading on Friday, August 9th. Notice things have gotten worse. In other words, this week of rebound did not cause a rebound in the speculative high potential growth areas of the stock market. Underneath the broad average rebound, you actually are seeing significant declines in valuation for the trailing 4, 12, 24, and 52-week timeframes, and also, in general, a further loss of relative strength. What does all of this mean? Well, quite simply, while some have seen this as a market recovery, I smell a dead cat bounce. One has to wait for further evidence of a rebound with convincing supporting market information before one can really expect good things from the equity market. And it's clear to me that the equity market remains at risk for further shocks and disappointments, at minimum until the September Fed meeting. For further analysis and information, join me at therabbicapitalist.com.